Hello everyone. Good evening everyone. Good evening everyone. Yeah, there has been a lot of discussion about time value of money, particularly for these UG and PG students. So I thought that let me give some inputs about the time value of money. Hi everyone, I am CA Manoj Kumar, and today's topic for our live discussion is the time value of money. So many people misunderstand about the time value of money. That why there is a change in the value of the rupee today and later. So today's 1 rupee is not equal to tomorrow's 1 rupee. So we already know this. This is called as the time value of money. Why? Because the value of the money changes over a period of time or on the passage of the time. So it is called as the time value of money. Right. So why we need to consider time value of money and why the value of the money changes from one period to another period. For example, say you have given a certain amount to your friend and asked, and your friend said that he will be repaying after some days. Now, if your friend does the payment after some days, are you willing to accept the same money that you have given to him or her? Maybe not. Maybe not. Why? Because if you are a good friend, then you are going to accept it. But if you are a finance guy, definitely I don't think that you are going to accept the same amount of money that you have given to your friend. So why are you not able to accept the same amount of money that you have given on an earlier day, and today you are not accepting that same amount of money that has been repaid by him or her? See, here comes the concept of risk. Now, had you not given that money to your friend, the money would have been safe in your pockets. Now, whenever you are given the money to your friend, then there is a risk of non repayment by your friend. Now, this risk you are taking, so definitely you are going to ask your friend to cover this risk, right? So, and that coverage will be in the form of paying some extra money to you. And apart from that, you should also understand that whatever you can consume today with the same money, you may not consume the same product in the same quantity in the future. That is another reason why there is a change in the consumption patterns that the money can buy today and the money which can buy after some time. Now, this will be another reason why you are going to ask your friend some extra money. Why? Because whatever the money that is used to purchase a product today, the same amount of money cannot purchase the same amount of the product in the future. So, as we know that there is a concept of inflation, so the same money cannot buy the same product in the future. Apart from this, don't you think that if you give the money to your friend, you are losing an opportunity to earn some money? Like, had you not given that money to your friend, definitely you would have deposited somewhere in the bank, or you have done investment somewhere which would give you certain amount of return. Now, since you are giving this money to your friend, you are losing that investment income. Now, this word in the financial terms called as the opportunity cost, right? So by giving the money to your friend for a certain period, you are incurring the opportunity cost. You are also losing the consumption pattern of the product, which means the product which you can consume today, you can't consume the same product with the same money in the future. The third one is you are taking the risk. Now you will ask your friend to uh, what we say cover these things in the form of some extra money or extra payment, So that is the reason why whatever money you have given to your friend, and whenever he does the repayment, both amounts will not be same, right? So these are the three elements involved in the time value of money, which is called as the consumption patterns, and then about the opportunity cost, and then the risk that you have taken, right? Due to these three elements, the 1 rupee today is not equal to the 1 rupee tomorrow, right? And you should also remember that today's money is more precious, more precious than the future money, right? Which means today whatever the money you are having in your hands is the certain money that you are having in your hand. In the future whatever you are going to get, there is uncertainty. So today's money is more valuable than the future money, right? So this is the topic that I would like to discuss, and give you some insights about this time value of money. And then comes our concept of cash flows. Listen, this time value of money we are going to apply in the business decisions. Now, how we will apply this time value of money in our business decisions? See, business is a continuous process, and whenever in this continuous process there are certain cash inflows and cash outflows happening, then obviously we need to apply this time value of money to take financial decisions, right? Why? Because today there may be some outflow in your business, and in the future there may be multiple inflows, or one inflow, one outflow, one outflow, one inflow, multiple inflows, multiple outflows, multiple outflows, multiple inflows. So these are the common things that happens in the business organization, right? Now the problem arises whenever anybody asks you to identify the cash flows. Means whenever you are about to do the cost and benefit, you need to bring all the cash flows into a single time frame, right? Now see, what is called a single time frame. For example, say if I deposit 10,000 today in the bank, and after 5 years I am going to receive 1 lakh 10,000, right? Today if I want to invest a 1 at 1 lakh, and after 5 years I'm going to get 1 lakh 10,000. if anybody asks me if anybody asks me that, please compare and tell me the decision. Now can I compare 1 lakh with 1 lakh 5,000 directly? Right, I can't compare. Why? Because the rupees 1 lakh is in the today's time frame, and 1 lakh 5,000 is there in the future time frame. So if I want to do the comparison, I need to bring both the cash flows into a single time frame, right? And then do the comparison, cost benefit analysis, which we say cost benefit analysis, right? So in order to bring the cash flows into a single time frame, we use the concept of time value of money. So we try to bring all the monies into a single time frame, either by using the concept of compounding or by the concept of discounting. So if we bring all the cash flows into today's time frame, then we call it as compounding. If we take all the cash flows into the future time frame, then we call it as dis- compounding. Present value if you convert, then it is called as discounting. In the future value, if you take all the cash flows to the future, then it is called as compounding. Done. So this is the concept of compounding and discounting. Now, how to convert your future cash flows into present cash flows? So once again, listen. In order to convert the future cash flows into present cash flows, we call that process as discounting. In order to convert the current cash flows to the future cash flows to the future, it is called as compounding. So discounting is done by multiplying your present value with the discounting factor, right? Which means the future money we are bringing to the present, so we are reducing the value through the concept of discounting. Now in case of compounding, we are taking the present value to the future, right? In case of compounding, we are taking the present value to the future, which means we are increasing the value in the future through the process of compounding. So we take the cash flows and multiply it with the compounding factor, increasing factor, in order to bring it take it to the future, right? Now in case of single cash flows, we just do the compounding or the discounting once. In case of multiple cash flows, means multiple times your cash inflow is coming, multiple times the cash outflow is happening, in that case we again still do the same concept of compounding and discounting, right? In order to bring all the cash flows to present or take all the cash flows to the future, right? And in this process, in multiple cash flows, there is one variant called as annuity. Now in case of multiple cash flows, when we call it as annuity. Now, if the cash flows are same, if the cash flows are same, if the cash flows are same, and the time period between the cash flows is also same, then the stream of cash flows are called as annuity. Right? For this stream of cash flows, we are having a separate name called as annuity. Now, can I say that in case of single cash flow, there is no concept of annuity? Yes, in case of single cash flow, there is no concept of annuity. Whenever there are multiple cash flows and the amounts and the time period between them is same, in that case, I call the stream of the multiple cash flows with a separate name called as what? Annuity. So for this annuity, I can find the present value or I can also find the future value, right? For this annuity, I can find the present value or I can also find the future value. So in case of this present value, I take the annuity, means the amount which is paid monthly or which is received monthly or paid yearly or received yearly, that is called as annuity. I multiply that annuity with the discounting factor to find the present value of annuity. To find out the future value of annuity, I take this cash flows or this annuity amount and multiply with the compounding factor, right? So present value means whatever the cash flows I am making, today's value, right, put together means the total value today. The future value of annuity means this number of cash flows is happening now, then what is the future value after 5 years, after 3 years, after 10 years, after 15 years, what is the value? That is called as future value of annuity. And in this multiple cash flows, we are having another one more variant. What is that? Called as another one more variant, which is called as what? Perpetual cash flows. Right? So whenever the cash flows are incurring to the organization or to a person for indefinite period of time, right? For what? Indefinite period of time, then we name those cash flows as perpetual cash flows. Now for these perpetual cash flows, it doesn't have any future. Why? Because the future is uncertain. In that case, we could not find the future value. We can only find out the present value. We can find out what? Only the present value. Right? So there is also another variant in this perpetual cash flows called as perpetual cash flows with constant growth rate. Right? Perpetual cash flows with constant growth rate. Now, as I told you, in case of perpetual cash flows, there is a stream of cash flows and it is incurring for indefinite period of time, right? For example, say you have invested in a share and you are about to get a dividend every year. So perpetual cash flows, till the company is there, until you are the shareholder of that company, for indefinite period of time you are going to get the cash inflows, means the dividend you are going to get. All right, so it becomes perpetual cash flows. Now perpetual cash flows with constant growth rate means the cash flows that we are talking, the every year whatever you are going to get, if it is increased by a constant growth rate, right? For example, say your dividend is increasing every year by 10 percentage, your dividend is increasing every year by 10 percentage, right? Then we call it as perpetual cash flows with constant growth rate, perpetual cash flows with constant growth rate, right? So we can also find out the present value of it, right? We can also find out the present value of it, right? So perpetual cash flows present value we can find by dividing the cash flows with the interest rate, and then this perpetual cash flows with the constant growth rate, right? We can find out by dividing the cash flows with the interest rate minus the growth rate. So this is all about your concept of time value of money. Right now where this concept is used, so whenever there is a capital budgeting decisions taken or whenever the cost of capital is taken, right there this time value of money plays a very very important role in financial management, right? And see, another point here is to be noted that, sir, are we going to use this time value of money whenever we are doing normal accounting? Right? So time value of money is not used whenever we do the normal accounting for the transactions which are supported by the bills or the voucher, right? Only in case of certain fair value items, then only then we record this concept of time value of money. Otherwise we don't do time value of money in normal accounting entries, right? Unless and until it is mandated by any accounting standard, we are not going to do any type of, we are not going to use this time value of money in recording the transactions in our books of accounts, right? I hope that you have understood. So please follow my channel for more updates on the financial management issues, auditing and taxation matters. Thank you. Have a nice time. And today is the lunar eclipse, which is going to occur in the night. So I know that in this generation, all the students will be more attracted towards the scientific reasons, but I would also request them to please listen to the elders, uh, where there is certain predictions over the astronomical or astrological, not astronomical, astrological issues which are given by our elders. So let us follow what is given in our culture, plus also let us follow what are the scientific predictions. And why? Because our cultural issues plus scientific issues both should go hand in hand. I hope you have understood whatever I was about to tell. So that's all for today. Have a nice time. We'll meet in another video.